Hello and welcome to our YouTube channel Chasing Bulls and Bears, where we talk about financial markets and more. Today in this video we are going to understand the concept of relative strength and how to read the relative strength on the chart. So let's first understand the definition of relative strength. As the name suggests, relative, it's a comparison of strength between any two stocks. So let's say you can compare the relative strength of Tata Motors in comparison with ITC, how Tata Motors is moving in comparison to ITC. It can also be comparison of a stock to its sector. So how any particular stock, let's say in our case Tata Motors, is performing in comparison to its sectoral index, that is Nifty Auto. It's also comparison of a stock to benchmark index. So you can compare Tata Motors with benchmark index in India is Nifty 50. So how Tata Motors is performing in comparison to Nifty 50. You can also compare two sectors. For example, you compare how Nifty Auto is performing in comparison to Nifty FMCG. And this is the most important part to find the outperforming sectors. So you can compare sectors with the benchmark index. So we compare, let's say, Nifty FMCG and check how it is performing in comparison to Nifty 50. Relative strength can be used for momentum investing. With relative strength comparison, it is possible to find the strongest as well as the weakest stocks or weakest sectors. Please be aware that only relative strength is not enough. So you have to apply technical analysis, price action analysis in addition to the relative strength, and then only you can take the trading calls. Also, one important point to note here is the relative strength is not equal to the relative strength index which we are very familiar with. But today, let us focus on the relative strength. So let's go more into the detail and understand relatively strong or outperformance of any stock. So let's assume we are comparing Nifty 50 with Nifty Auto. Nifty 50 goes up by 1%, and at the same time Nifty Auto goes up by 2%. That means it is relatively strong. Nifty Auto is relatively strong to Nifty 50. Or Nifty 50 goes down by 1%. At the same time, Nifty Auto only falls by 0.5%. This is also a sign of outperformance. We can say Nifty Auto is outperforming Nifty 50. What is relatively weak, or how to understand, how to read underperformance? So in this case, let's assume Nifty 50 is up by 1%. At the same time, Nifty Pharma is up by only 0.5%. That means Nifty 50 has gone up more than Nifty Pharma. That means Nifty Pharma is relatively weak to Nifty 50. Also, if Nifty 50 falls by 1%, at the same time Nifty Pharma falls by 2%. This is also a sign of weakness. This shows that Nifty Pharma is underperforming Nifty 50. So now you got the concept of relatively strong stocks and relatively weak stocks. Let's just to understand, take a look at the definition of relative strength. So it's just a ratio. You divide the stock price by benchmark index, or if you want to compare two stocks, you divide the price of the stock which you want to compare with the other stock's price. Or you can also say you divide the stock price by any sectoral index to see how any particular stock is performing in the particular sector. So why we should invest in relatively strong stocks or sectors? Why it is important? You can also, as Warren Buffett says, you can also make money in investing in the indices ETFs. So you can invest in Nifty 50 and still you will gain over time and make good returns. But we just don't want good returns. We want better returns. And that is the reason why you should be looking at the relatively strong stocks or sectors to invest in. So in market there are more than thousands of stocks, listed companies, and you cannot go and invest in all stocks which are looking good because our capital is finite. I don't know if you have infinite capital, you can go and do that, but mostly the capital is finite, so we have to find the right stocks. So stock market is a forest and you have to find the tree which you want to take. So the relatively stronger stocks will give better returns than the relatively weak ones. We will take look at the examples of the relatively strong stocks and how a relatively stronger index performs better than the relatively weak index. So you have chances of getting better returns in the relatively stronger sectors. If the capital is deployed in the relatively weak stocks, you lose the opportunity to get better returns. So that is the opportunity cost. You lose the opportunity to make better returns by investing in the relatively stronger sectors. Also, one important point is the risk is reduced if we are investing in relatively stronger stocks. What it means is that if the market falls, the relatively stronger stocks don't fall as much. So if the market, we just saw, if the market falls 2%, the relatively stronger stocks will fall only 1%. With the RS approach, one can find the best performing sectors and select only those stocks which are showing outperformance compared to the broader market or the benchmark index, which is Nifty 50. RS study can help us to find the stronger names. Now, this is the matrix which I have created, and I think we can also go through some examples and understand it better. But this is again repetition, and I want you to, really go and look at the charts and try to see this stock price and the relative strength and try to read the price action. Yeah. So here we have the stock price or the sectoral index, the relative strength, and what we read from it. If the stock price or the sector is going up and the relative strength is also going up, we are in sync with the broader market. I see a spelling mistake. If the stock price is going up or the sector is going up, but the relative strength is going down, that's a sign of underperformance because the index is going up, but the relative strength is going down. That means we are not in sync with the market, we are underperforming the broader market. If the stock price or index is down and the relative strength is going up, that's a very good sign. This is a sign of outperformance because the index is falling, but the relative strength is increasing. That means the index or sector is not falling as much as the broader market or Nifty 50. And the last case is the stock or sector is going down and the relative strength is also going down. We are in sync with the broader market and we are falling with the market. So if the stock is showing signs of underperformance, what does this mean? It's not a good idea to initiate any new positions in this in such a stock or a sector. Also, you can, if you do so, the returns which you would get would not be as good as the returns which you would get if you invest in the outperforming sector. If the stock is showing signs of outperformance, that means price is going down, but the relative strength is going up. This is where you should, look at the stocks charts, indices, and sectoral indices, and try to find the strongest stocks and look at the price action and initiate the trade with proper plan, entry, exit, and stop loss. And this is where the probability is high that you will get better returns in comparison to the stocks which are underperforming. Now let us take a look at the Nifty IT. How we can see that Nifty IT is going to outperform in well in advance. Yeah. So the COVID came and Nifty IT started falling also with the markets. But at the same time, if you look at the relative strength of Nifty IT in comparison to Nifty 50, it went high. So the price is going down, relative strength is up. What we learned, that shows outperformance. Now this is the time where you should be looking at the sectoral constituents. So you go and check the charts of Infosys, TCS, Wipro, Persistent, and so on, and try to find which stocks can outperform the market going further. So this is the first step. So in the COVID fall, you saw the Nifty IT fell, but the relative strength improved, made a higher high. This is the sign of outperformance. You go and start observing the constituents and plan your trades. Also important to note, Nifty IT was the second sector to break above the pre-COVID high. So it broke. We'll go to that in the next slide and see. After pharma and leaded the rally, and there was no overhead resistance. So on the left hand side, there was no price action. There were no stuck investors which would book profits after the breakout. So the probability of this breakout was very high, and we had the confirmation from the relative strength as well. What we see here is after the fall of COVID, stocks, Nifty IT gave a breakout. Also, the relative strength gave a breakout. So both were in sync, price and relative strength, and we had a major rally. You can also, without using the relative strength chart, you can also spot the relative strength by your eyes. You can just see here on 13th of July 2020, the Nifty IT was already crossing the pre-COVID highs and this trend line. But at the same time, Nifty 50 was way below its pre-COVID high. That means Nifty IT was showing the signs of outperformance to Nifty 50. So without even looking at the relative strength chart, you can read the price action and say here on 13th of July, Nifty IT is stronger than Nifty 50. And this is how you can also read relative strength on any chart compared to benchmark index. Why I mentioned earlier that you should invest in the relatively stronger sectors to get more returns. So if you would have invested in the Nifty 50 index from 13th of July, you would have got only 70% return. So I know nobody can catch the bottom or top of the market, but just to compare, just to give you an idea, here, if one had checked the relative strength, checked the breakout, and said saw the sink in the price and also the relative strength and invested in the Nifty IT stocks or Nifty IT ETF index, he would have got 125% return from 13th of July. So that's more return than 70%. This means if you invest in relatively stronger sectors, you get better returns. Now, to get the idea of underperformance, let's take a look at the Nifty FMCG chart. Here you see also with the in the COVID fall, Nifty FMCG fell, and then we also saw good upside on the relative strength. This means the Nifty FMCG was falling, but not as much as the Nifty 50, and we had a high of relative strength. But what we saw in the Nifty IT chart, that the price should also be confirmed along with the relative strength. So they both should go in sync. Now here we see that the from the fall the price was going up and the relative strength was going down. So this is the sign of underperformance. When you see this, you don't want to get in this sector even though you had a breakout here on the this is a multi-year breakout from 2019, tested once and then nice breakout. But if you see the relative strength, it was falling. So it was not showing strength. Let's see what happened after that. Even if we had this breakout, relative strength kept going down. sign of underperformance. The Nifty FMCG only rose by 29%, whereas the index we saw rose by 70% in this period. So you got relatively less return in this sector because this sector was relatively underperforming Nifty 50. So let's go to the summary. First of all, what we have to do is study the relative strength of sectors against Nifty 50. By doing this, you will get the outperforming and underperforming sectors. So let's say now Nifty Auto is outperforming, Nifty Pharma is underperforming, for example. Then you go to Nifty Auto because it is outperforming the market. So you see that the price is going up or the Nifty Auto is going down, but the relative strength is going up. That is a sign of outperformance. You find the leaders and laggards. So leaders would be, let's say, now take an example. Tata Motors is leading, or Tata Motors has already moved much higher than the index. So that would be the leader from this sector. Or let's say Tata Steel from Nifty Metal has already broken previous supports and the index is yet to break support. So that means Tata Steel would be the laggard stock or the underperforming stock from Nifty Metal, for example. So by doing this, you will get the list of the best and the worst performing stocks. After doing this, check the broader market direction. Are the markets in uptrend? Are the markets in downtrend or sideways movement? So you can just check the trend of the market, uptrend, downtrend, or they are just going zigzag in a range. So trend is our friend. If the broader markets are in an uptrend, we look for long opportunities. If the broader markets are in a downtrend, we look for short opportunities. If the markets are consolidating, we wait for either a breakdown or a breakout and then initiate the trades accordingly. As I already mentioned, relative strength is not enough to achieve super performance. We have to have some knowledge about price action and technical analysis along with the relative strength to achieve better results. And that's it from my side. This was the concept of relative strength. I hope you were able to follow the concept and the methods I mentioned in this video. Thank you very much for watching this video. Please like, comment, share, and subscribe. If you have any questions, let me know and we can discuss about it. Respect risk and peace out. Thank you very much.